All right, welcome to this explainer, everyone. Today, we're diving deep into the actual mechanics of technical analysis, pulling directly from our sources to see exactly how world-class proprietary trading firms operate. If you've ever looked at your charts and felt like they were just random, confusing lines on a screen, trust me, you are definitely not alone. We're going to break down how real institutional trading relies on clean, systematic consistency, rather than just guessing and hoping for the best. So here is our exact playbook for today. We'll be moving through 6 key steps. First, the professional edge, then drawing lines, psychology and levels, top-down analysis, the break and retest strategy, and we'll wrap it all up with management and risk. Let's kick things right off with section 1, the professional edge. Now, if you want to trade like a pro, you really have to look beyond the surface. You've got to understand who is making these market moves behind the scenes. Think about this stark contrast in approaches here. Beginners, they usually end up with these chaotic, amateur spiderweb charts. They draw a line across literally every single high and low, kind of just hoping that if they draw enough of them, eventually one is going to work. It's confusing, it leads to false breakdowns, and honestly, it's a mess. But the professional approach, it's all about clean charts. Pros use a highly concrete, rule-based system. They know exactly why a line is there, and if a line doesn't serve a strict structural purpose, it gets completely deleted. And here is the core logic behind those clean lines. Trend lines aren't just magical boundaries that price respects for no reason. Our sources make it clear. Trends are actually driven by passive algorithmic buy and sell programs. These are massive institutional algorithms programmed to buy or sell incrementally as the price fluctuates. They aren't aggressively chasing the price, they just passively execute when the price comes to them. And that repetitive, highly mechanical behavior, that's exactly what paints the trends we see on our screens. Which brings us to section 2, drawing lines. Let's look at how to plot them correctly. Now that we know why trends form, let's talk about the how. First things first, professionals completely ditch the standard trendline tool. Why? Because the standard tool just stops at point B. Instead, you want to use the ray tool. The ray tool automatically extends your line indefinitely to the right, straight out from your starting point. This is absolutely crucial because we need to see exactly how price might react in the future, long after those initial touchpoints are formed. Okay, so how do we qualify a valid line? There's a strict 3-step institutional rule for this. Step 1, identify a distinct starting point. This is usually driven by a major fundamental catalyst or a really obvious shift in price action. Step 2, apply the 60-bar rule. Always zoom out so you're looking at a minimum of 60 bars or candles on your time frame. This just makes sure the trend actually carries some weight. And finally, step 3, the 3-touch rule. 2 touches just make a line, but a 3rd touch, actually scratch that. It's not just a 3rd touch, it's a hard confirmation that the trend is actually real. And hey, this simple rule answers one of the biggest, most eternal debates in trading. Do you connect the wicks or do you connect the bodies of the candles? Well, the proprietary firm rule of thumb is surprisingly simple, and it's based entirely on that very first catalyst candle. If the initial candle that starts the trend has a wick, you connect the wicks. Simple as that. But if that first candle has a flat body with absolutely no wicks, then you connect the bodies. It completely grounds your expectations in the pure data that started the move. Moving right along into section 3, psychology and levels. You know how a stock sometimes just mysteriously stalls out at a nice round number? Well, there's a reason for that. Specific increments, specifically half-dollar and whole-dollar marks, act as invisible psychological walls in the market. Think about it. When traders set their profit targets or place their stop losses, they rarely use a random messy number like $7.13. They use $7 or $7.50. And because of human psychology, millions of orders naturally cluster right at these exact whole and half-dollar levels. Let's break down what's actually happening at those invisible walls by looking at the order book. When price is moving up and hits a ceiling, we call that resistance. In market terms, that's just an overwhelming supply of shares provided by sellers. Conversely, when the price drops and hits a floor, that's support, and that represents massive demand stepping in from buyers. It's basically a constant tug-of-war happening right around those psychological whole numbers. But what happens when one side actually wins that battle? When buyers chew through all that supply and convincingly break a major resistance ceiling, we see this fascinating phenomenon called role reversal. That broken resistance level flips, and it often becomes the new support floor during a retest. Basically, the old ceiling becomes the new floor. All right, section 4, top-down analysis.
You literally never want to draw a trend line in isolation. Professionals always frame the context of their trades across multiple time horizons to ensure the wind is at their back. You start from the top and fan out. First, look at the monthly and weekly charts to find the big picture overall direction. Second, drop down to the daily or 4-hour chart to capture the current momentum with steeper lines. And third, zoom in to the 1-hour chart to find your specific execution entry. Oh, and here is a golden rule you must follow. Never let price poke through your lines on the higher time frames. If it intersects your line, the line is totally invalid and you've got to adjust it.
Now for Section 5, break and retest. Let's talk execution strategy. I want you to really think about this for a second. Why do most breakout traders lose money? It happens literally all the time. The price violently breaks a trend line, an amateur trader gets massive FOMO, they buy immediately, and bam, the price reverses. They get caught in a fake out and completely torch their capital just because they had zero patience. So here's how the pros completely avoid that trap. First, when a line is broken, you look for a large energetic breakout candle. Once you spot it, take your rectangle tool and draw a box around that specific candle's entire range. Then, you wait. Just wait for the price to pull back and retest that box. Finally, you don't enter blindly. You look for rejection wicks or a doji candle bouncing off that box. That is your high probability confirmation to finally pull the trigger. Okay, so you're in the breakout trade. Now, where do you actually take your profits? Well, the targeting sequence works perfectly in reverse. You simply look back at your old trend line and use its previous touch points as your logical take profit zones. Point C is the most recent touch before the break, point B is the middle touch, and point A is the origin touch where the whole trend started. The market remembers these levels, making them the absolute perfect systematic targets for your gains. And finally, Section 6, management and risk, protecting that hard-earned capital. All right, you've built the trade, you're in profit. Now, how do you protect it? Once a winning trade is moving fast, how do you know when to get out without giving it all back? Enter the safety line technique. A safety line is a new, much steeper trend line drawn straight from the exact touch point of your entry, tracking that aggressive momentum. As long as the price stays above this steep safety line, you stay in the trade. But the second a candle closes below it, you exit. No questions asked. And that leads us perfectly into one of the most effective institutional management techniques out there, the half and trail exit strategy. When your trade gets that first major energetic move and hits your first target, you scalp half, meaning you immediately sell 50% of your position to lock in guaranteed profit. Then you simply trail your stop loss on the remaining half right behind that safety line we just talked about. It completely removes the emotional stress and lets you ride the big trends safely. Now look, absolutely none of this matters without the golden, unbreakable rule of professional trading: risk management. Our sources make it crystal clear. You should never, under any circumstances, risk more than 1 to 3% of your total account capital on a single trade. I don't care how perfect that break and retest looks, the market owes you nothing. By strictly capping your risk between 1 and 3%, you ensure that a bad trade, or even a whole string of them, will never wipe you out. To wrap this all up, I want to leave you with a powerful reminder straight from our sources. Trading is a skill that takes time, not a get-rich-overnight scheme. Keep your charts clean, stay patient, and let the price come to you. So, here is my final provocative thought for you today. Are your current charts a clean, logical roadmap to success, or are they a chaotic spiderweb holding you back? Take a really hard look at your platform today, delete the noise, and start trading with real intention. Thanks for joining me on this explainer, and I'll catch you on the next one.